Hi, James Woodburn here for The Insider. Today I'm joined by our fellow editor, Greg Canavan and Murray Dawes. Welcome, guys.
G'day.
G'day Woods, g'day Muzz.
Hey, mate.
Yeah, I thought it's about time we caught up again and chewed the fat a little bit. There seems to be a ton of stuff going on. So we want to cover a couple of things today. Obviously, the moves and moving gold is a big one. And there's a few things on the markets we want to chat about. Murray's also, you've got some interesting insights from a pretty big fund manager over in the States. But I thought I'd just address a reader email that we got in the last couple of days, Greg. It's from Perry. Please ask Greg Canavan to spare us his commentary on COVID-19, climate change, and any other political commentary. I'm not interested in his political opinion, and it's not what I signed up for. Now, here at The Insider, we don't want to cover pat ourselves on the backs. We want to take criticism head on. So why don't you address that? I mean, one question I got in response is, can you really separate politics from the markets anymore?
Well, I think there's two ways to answer that question. That what we try to do here at Portfolio Publishing is obviously give a range of different views. Now, the question is, are political views necessary or welcome when you're talking about trying to make money from financial markets? And, I agree with Perry on that front. And in my paid subscription Crisis and Opportunity, I very rarely delve into the political side of things that are going on in the world today. And I try to stick to what's happening in markets and talk about different investments that you can make to take advantage of what's happening in markets. The other side of that coin is that in our, the free daily e-letter that I write in, Rum Rebellion, and also The Insider, which is a complimentary service for our paying subscribers, we give ourselves a little bit more latitude to talk about some of the issues that are not discussed at all in, or what we believe aren't discussed at all in the mainstream media. And, we're a company that is very much encouraging of freedom of thought, freedom of opinion, all those sorts of things that, and we've had private discussions about this in this day and age, are becoming increasingly frowned upon. We're in, the age of cancel culture. And it's just getting to a point of being absurd. And I know there's a lot of criticism about some of the stuff I write when it comes to climate change, or when it comes to the performance of, say, the Victorian government and how they've handled their response to COVID-19. And fair enough, people can complain about it, but I make no apologies for that, because there's also a lot of people that appreciate those viewpoints, because those viewpoints aren't necessarily heard in the wider media. But, without getting into it too much, I agree with Perry's point that, we're ultimately here to give people investment recommendations and try to make people money, which is why I keep these discussions for The Insider and for the Rum Rebellion, which, as I said, we give ourselves a little bit more latitude in those publications to write about some of the issues that you don't see necessarily in the mainstream media, and just, shift a little bit away from the investment side of things.
And the one thing I would say is we don't really have an allegiance to left or right. We just call out bullshit, really,
Yeah, that's true. I mean, personally, I would consider myself, centre-right. Some of the politics of today, and especially in the US, have moved so far to the left that even if you are left, you'd be considered, right-wing today. Once again, that's a development that's come over the past few years, is that, this splitting of left and right viewpoints, which, it's almost impossible not to fall into one or the other if you are talking about politics in this day and age. But, it's just something that I feel that as an organisation that writes about investments and also writes about political views, and especially Rum Rebellion, that was based on wanting to, as you said, call out bullshit when we see it. If people are talking out of the corner of their mouth, we're going to call that out as well. Sometimes those views are popular, sometimes they're not. And, you're never going to keep everyone happy, and it's not our objective. Our objective is to ruffle feathers and call it as we see it, and make no apologies for it.
But I guess it's just symptomatic, isn't it, of you take a step away from the politics, is that what central banks are doing is massively impacting on the markets. And Murray, you have a first-hand view of that, because you're watching the markets every single day. And I mean, what they should be doing and what they are doing just seems completely at odds, doesn't it?
Well, I mean, we're decades into this game, aren't we, of the Fed riding to the rescue whenever there's a problem. And I think the COVID crisis has pressed the fast forward button on all of this. And we're seeing the end game in full view, that when things went pear-shaped, they've basically gone all in. Limitless QE, supporting all markets. Now, it's working for now, but we are seeing some of the effects of that. M2 money growth spiking massively, and we're seeing gold breaking out to new all-time highs. We're seeing also in commodities across the board. I'll show you a few charts. Zinc, we had zinc up 4% last night, nickel up 4% last night, rare earths up 4%. I got monthly buy pivots across the board in those. And so for me, I'm starting to see this sense, and also Bitcoin flying, of an inflationary phenomenon, the early sort of signs of that. And maybe that's just investors thinking that's what's coming and front running it, and that might fall over. Greg might have a view on that. And I'm not sure, what the outcome's going to be, but from where I'm sitting, I'm seeing the effects of the US Fed's policies now really starting to have an effect, with the US dollar cracking below major support and looking really interesting that it could sell off a lot further. And it's all the repercussions of that, the global capital flows that will come as a result of that. So I'm having to recalibrate my thoughts a bit. I've been really bearish and holding on, and our market hasn't really moved much in the last few months since we've spoken. I still think it looks dangerous. But of course, the NASDAQ on an absolute tear, it's like a blow-off rally. And I see that the market breadth is really thin, all the money going into a few stocks. For me, that's almost like a safe haven money flow as well. So you've got Bitcoin flying, gold flying, the strongest balance sheets in the world flying. There's lots of money searching for a home, which is also searching for a way that they're going to survive what's coming. And the way that the Fed is really just affecting the markets in this immense way after that crisis. So that's sort of how I'm seeing it. And I'm only just now putting together all those pieces of the jigsaw and having to respond to it.
Let's talk about that. I mean, so this week, gold. So you mentioned gold, right? It's already in Aussie dollar highs in Aussie dollar terms, but the real significant one was the I think it was the all-time high ever in US dollars, right, Greg? I mean,
yep.
And that happened because we were talking. That happened, overnight, because we were talking it on Tuesday, and by Wednesday it busted through. And I think it's still above there now.
Yep.
Yeah, I mean, and back to your earlier point, Woods, talking about how monetary policy does affect society and creates these issues in society. If you go back to 20 years ago, the US dollar gold price was around $200 an ounce. It's just breached $2,000 an ounce. So over the past 2 decades, you've seen a massive debasement of the world's reserve currency. And the US dollar is relatively strong compared to most of the other currencies around the world. So across the board, you've seen a huge debasement of fiat currencies. And when currencies are debased, it leads to, and I don't want to sound moralistic about this, but it does lead to a debasement in the morals of society as well. And you've seen that across various parts of history. I mean, you look at the great inflations of history gone past, it comes with massive societal upheaval. So we're sort of experiencing a lot of that stuff today. One of the things that really confuses me at the moment is that you're seeing every asset price rally, and I'm talking about bonds as well. And just this week, the US 10-year bond yield hit all-time lows and actually broke through the lows that they reached in March when the global economy shut down. So if we're talking about inflation, but the bond market is not seeing inflation at all. If it was genuine inflation or a genuine inflationary outbreak in terms of goods and services prices, you would see bond yields rising at a rapid clip. At the moment, bond yields are going down, which means the bond market does not see inflation happening anytime soon. So the inflation is really confined to monetary assets, and it's every asset that's it's inflating. So I know Muzz has got some charts. I don't know if you want to run through those now, but there are, and I read about this in Rum Rebellion this morning. It's a tale of two markets. The equity market is saying one thing, and the bond market is saying something completely different. So I think in the next couple of months we'll certainly find out who's right.
Just before we go into the charts, just out of curiosity, so because it just, like you say, it doesn't feel, you go to the shops, you don't really see the inflation on a day-to-day basis. Do you think when, almost like when the economy opens up again, inflation's going to almost flare up like the virus? Do you know what I mean?
It could well do. And, I think there's, historical examples of where inflation doesn't really look like it's a phenomenon at all. And then all of a sudden it breaks out. But in order to get inflation, you need to have money turning over through the economy, and the velocity has just been going down and down and down and down. So, it could be in our future, but right now the bond market is saying that's not the case. That's the main sort of comment I wanted to make on that matter.
So what have you got for us, Muzz?
Yeah, well, I've just read what is a really interesting article by Paul Tudor Jones, who many people would know, one of the most famous hedge fund traders from the 80s and 90s. And he's just written an article on the Great Inflation and sort of giving an overview of where he thinks, money should go to protect from what's coming. And there were a couple of just really fabulous charts in there. So this is the chart I want you to focus on. And this shows US inflation, which is that blue line there. And the red one is M2 money growth, less real GDP growth.
So just for some readers, Muzz, sorry, just to interrupt you there. Can you just explain very simply M2 money growth?
Well, that is like your money stock, money in the bank, also like in funds, ETFs. It's a great overview of the stock of money. Gotcha. And when it's really taking off, that's a bit of a precursor, giving you a sense of the money liquidity situation, and it can end up affecting inflation.
Gotcha.
So if you look at this chart going back to 1922, and you look at the relationship between that M2 money growth and the inflation that ultimately comes out, there's a very high correlation you can see there. And the point that Paul Tudor Jones makes is that when we got in after the crash, the M2 money growth spiking, but we didn't really see inflation picking up, he's basically saying that the banks at the time had damaged balance sheets from the crash. And in order to repair their balance sheets, that money creation really went to repairing their balance sheets and didn't flow out. Like Greg was saying, the velocity of money wasn't there. It didn't flow out into the economy. It didn't pick up in inflation. And he's saying this time around that the bank's balance sheets are much better than they were. They are pretty much repaired. And you're seeing this massive spike here in M2 growth, which is, really taking off. Even more than during the crash in 2008. And so he's basically saying that, what do you think might be the next step for CPI inflation based on looking at 100 years of data and the relationships? So, that's a very big point that we need to sort of understand after this COVID crisis, that, it is possibly going to start feeding in. And where I'm saying that, maybe the inflation hasn't started, but if we look at a few charts, and I just wanted to show you a couple, we've got zinc here on a monthly chart, and you can see we've got this big rally from 15 to 17, and people who have watched my videos will know I see this as like an ABC correction, which has gone back down into the buy zone of that whole wave. And now we've got the monthly buy pivot confirmed, and prices shooting up. Zinc up 4% last night. For me, that's quite a bullish chart on zinc. And across the board, I'm seeing it as a pretty similar situation. In nickel is a similar situation, where there's been a long recovery phase in the last few years, but the trend is up. You can see there, prices have just pulled back. And again, if people have been watching my videos, into the buy zone of the previous wave within the uptrend. We've just had a monthly buy pivot confirmed last month, and prices are shooting out of the blocks this month. Similar thing with copper, which I'm sure people have been following, where we've seen a huge spike in copper. Again, this is a monthly chart. You can see this is a huge rally from 08 to 11. Prices again have pulled back into the buy zone of that whole wave. We've got this monthly buy pivot and a huge spike in copper to the upside. And aluminium's a similar story. So I'm just seeing in the commodities across the board these very sharp moves out of big support. My charts are sort of going, wow, this is sort of a shift and a possible new bull market. And to me, it sort of does make sense if we're looking at US dollar going to be sold off, lots of money printing, massive M2 money growth. Possibly that is the story of the future. So I'm watching it very closely. I've already bought rare earths, uranium, and possibly a few more. But I have been wrong-footed a bit by the strength of this rally after the crash. But it's just the picture is starting to come into my mind that this is a monetary phenomenon, and it may have a lot further to run.
So do you think it's more so a monetary phenomenon than an actual demand for resources?
Well, I mean, the demand for resources will be there if you think there's $1.8 trillion of printed money sitting at the Fed's account for the US Treasury right now. So the Fed prints money, they then buy US bonds. The US is issuing huge amounts of bonds. They've now got $1.8 trillion of that printed money sitting at an account with the Fed, and they're just about to announce a multi-trillion-dollar stimulus package. And that might involve building bridges, building infrastructure, basically spending that printed money on real commodities. So that's where that inflation can first sort of pick up.
You're not the only analyst among us to pick this up. I had a good chat with Ryan Dintz, the editor over at Exponential Stock Investor and the Small Cap Momentum Alert. We had a great chat last week, and he said you see the horrible economic data, and then on the other hand, he's getting more buy signals and more momentum alerts than he ever has done in the previous year. So it's kind of like a weird juxtaposition going on right now. It's something you've noticed as well, Greg, isn't it?
Yeah, absolutely. I mean, I guess the one thing I'm generally skeptical of most things until I can. Probably similar to Muzz, until you can sort of rationalize it and until you can sort of see some of the evidence that's playing out. One of the things with charts is you look at charts and the market generally knows things well before it becomes apparent. So you do have to put a bit of trust in the price action, and you do have to say, well, hang on, these charts are telling me something here and I need to sit up and listen to what that is. I guess my issue at the moment is that I'm seeing a lot of mixed signals, which makes me question how that would be. So at the moment, the narrative in the market is the Fed's printing money, all this printed money is going to asset prices, and the Fed's just going to keep doing it and keep blowing things up. The Fed's balance sheet actually peaked on the 10th of June. So getting close to a couple of months ago now. It hasn't fallen a lot since then, but it's fallen around about $200 billion since the 10th of June. And I'll show you some charts in a moment just to see where that point is. At the same time, the ECB has continued expanding its balance sheet, and there's a program that it put out called the Pandemic Emergency Purchase Program. So it kicked that off in March with a $750 billion euro asset purchasing program, and extended it in April with another $600 billion. So at the moment, from the Fed's peak on June the 10th until now, the ECB's balance sheet has expanded by 700 billion euros, which is just a bit over 800 billion US dollars. Now, if the euro is expanding their balance sheet, or the eurozone is expanding their balance sheet, and the Fed isn't, you would expect the US dollar to rally against the euro, but that hasn't happened at all. And I just want to show you a chart here, just to show you what I mean. So if we look at this chart, this is the chart of the euro versus the US dollar, and for pretty much since the lows in May, it's spiked massively. but the Fed's balance sheet peaked at this point on June the 10th, yet the euro has continued to rally. So that doesn't make a lot of sense to me in the narrative that we're hearing at the moment that, the Fed's printing loads of money and that's why the US dollar is going down. The US dollar is going down because the euro is going up. The euro is going up despite the ECB printing a lot more than the Fed. The euro ECB's balance sheet is actually bigger than the Fed's balance sheet. So that whole thing doesn't make a lot of sense to me. There's a couple of other charts that I just want to run through quickly while I've got the screen on here. This is the Aussie market, the S&P ASX 200. Funnily enough, it peaked on, I've got it there, Wednesday, June the 10th, the same time as the Fed's balance sheet peaked. I'm not sure if that's just a coincidence or there's some, correlation there. But this is when Woody and Muzz, we first started having our discussions with, subscribers to say, look, is the market going to continue rally? Do you think it's going to turn over? Despite, the next couple of months, the Aussie market's done nothing. And that's really, I guess, a bit of the nature of our market. You've got financials under pressure, the banks under pressure, given that the economy is still quite slow and the fact that Victoria has gone back into a hard lockdown, which is going to, have a big impact on our economy. Even though resources have done quite well, they haven't done enough. The bigger resource stocks haven't done enough to see this overall market break out. Yet, by the same token, the S&P 500 is nearing its old record highs. The thing I wanted to point out here, though, is you are seeing, and this is not always a fail-safe method of saying it's a false breakout, but you are seeing a divergence in price. So you've got a peak here back on the 10th of June when the Fed's balance sheet peaked. The price corrected back a little bit. It's since gone on to new highs just after this one. Yet the momentum of the market, as measured by the RSI, that peaked around the same time, 9th, 10th of June. And ever since then, it hasn't really recaptured that same level of momentum. And it's the same thing in the NASDAQ. As Murray said before, it's almost like a blow off top for the NASDAQ. And it's really concentrated in a bunch of big tech names that are driving this. But once again, as you've seen the NASDAQ just go on to new all-time highs, you've seen momentum wane as well. And that, if I can get the cursor over that properly, that peak back here was around the 10th of June when the Fed's balance sheet peaked as well. And I guess
which editor was it, Greg?
About the inflation.
Which editor, Greg, was it this week that coined the term the S&P 5?
I think I wrote that in the Monday version of Insider, and yeah, that just goes to the point about the 5 big tech stocks is the ones that have delivered all the gains this year in the S&P 500, while the 495 other stocks have contributed nothing. Which it's just talks to the concentration of the market, and I think when markets are very concentrated like that, and Murray made the point that there's just a real lack of breadth, and that's what that means. There's not a wide expanse of stocks that are all performing well. Concentration of stocks doing well is quite dangerous. But just lastly, before we get back to our chat, I just wanted to show you the chart of the Aussie dollar here. And look, that's telling you that this inflation story that Murray was talking about in the commodities and the resource stocks, that is alive and well. And the Aussie dollar is doing quite well. It's trending higher. So, as I said, a lot of mixed signals. And that's where I sort of struggle because, on the one hand, some markets are telling you this story is in effect. And on the other hand, there's, some warning signs to say, hey, hang on a sec, you can't get too excited about this because there are a lot of other reasons to be quite worried. But that's how markets work. It's never easy.
Mm. So what are the specific areas that you are looking at right now? So you're saying there's mixed signals, but I mean, Murray, you're obviously looking at the resources sector, I take it, because that's where the charts are telling you. Yeah, well, look,
I've got a bunch of gold stocks. We've got 4 in the portfolio. Like I said last time, internet retailer, which has flown out of the blocks due to COVID. So I've got a wide array of things I'm looking at. But yeah, I have picked up some rare earths and uranium. Really on a value play on the uranium side, and the rare earths, again, it's based on the charts I was showing you where I'm seeing a big false break of a major low on a monthly buy pivot, and going for the strategic value of rare earths. So, and I'm sort of looking at a well-diversified miner, looking to pick up because I'm looking at zinc and nickel and amongst other things, and they're exposed to silver as well. So yeah, I am seriously thinking that this might get going. You know, whether it's a false start, whether people are you know, getting long all this stuff, seeing this inflation picture, and sort of everyone's rushing in, but then the demand's not there ultimately, and things fall over again in a few months. You know, who knows? But I've just got to respond to what I'm seeing, and the way that the US dollar has cracked, and the way that Bitcoin and gold are moving, and these other commodities, is I really do have to sort of sit up and take notice and have a good long think about that aspect. That, you know, what's changed since the crisis? I mean, the Fed's changed. They've gone all in and are willing to backstop the market completely. And maybe now that they've sort of done that, where they've said, look, we're willing to do limitless money printing to keep everything afloat, you know, maybe now the market really is completely convinced the Fed put is there. And maybe the markets have got to go completely crazy, a massive blow off that might last another 6 months or a year of going vertical. You know, this is a sort of crazy world we're in, that we're having to respond to these very immense things that are happening. And like I said, I feel like everything's fast forwarded. The Fed's been doing this for 20 years, slowly, always being there to hold the market up. And now when a big crisis came, they basically went all in. And they've even said they're going to let inflation run hot for a while, you know, that they're trying to get the market to accept that that's what they're going to do. So, for me, this is the biggest thing that I'm noticing in the markets. And I guess I've got to respond and trade accordingly.
Mm. And Greg, what does your current buy list look like? Just the makeup. Obviously, you don't have to go into the specifics, but
yeah, look, I've like Muzz and for years I've had gold stocks in the portfolio, and they're, you know, some of those are up triple digits. I haven't really been adding too much recently. I've been adding stocks to the watch list. I've got some iron ore miners on the short selling watch list, which means I think there's a risk that they're topping out. And just to put that into context, I guess my overall bigger picture view at the moment is that this whole COVID thing is going to do a lot of damage to China longer term. And if damage is done to China longer term, then that's going to have an effect on Australia. Shorter term, it's done wonders for iron ore, especially because China's had to go back to the old, geez, you know, we don't have much growth here. We've taken a massive economic hit. We need to just generate growth very quickly. So the government has ordered the state-owned banks to lend for fixed asset investments. So that's been very good for steel makers and obviously for iron ore demand. At the same time, Brazil had some massive COVID issues, which restricted their ability to supply iron ore as well, which is the second largest iron ore supplier in the world. So that's played into the hands of the Aussie producers. So everything has come together, almost a perfect storm for iron ore producers. And when I see that as a contrarian, I think, well, how much better can it actually get for those stocks? So I'm looking at those as a contrarian sell. And at the same time, I guess it's a bit of a pair trade. I'm looking at the banks over the next few months as actually being a particularly good long-term buy. If you ask anyone if the banks are a buy at the moment, they'll tell you no. You know, they're not. Intuitively, it doesn't make sense to buy into banks in a recession, but banks have been in a bear market since they peaked in 2015. So we're already 5 years into a pretty nasty bear market for the banks. You know that the government is going to bail out banks. They're not going to go bankrupt. So I sort of look at the banks, and I'm not buying in yet. As I said, I've got them on the watch list, and I just do think over the course of the next 3 or 4 months in Australia, you're going to see the banks basing. In the next couple of years, the markets will re-rate them as bond proxies, because all the banks do is hold the debt of household and real estate in Australia. So if they're just clipping the ticket on that debt servicing, they're still going to generate a lot of profit, not at the same levels of profitability they have in the past, but their share prices have come down massively. So you're not actually overpaying. You're paying a reasonable price for bottom of the cycle earnings for banks. And I don't think they're going to go into their growth rates of what they've done in the past 10 years. But certainly if you're looking for income, and I guess my newsletter is a little bit more of a conservative newsletter for people who are looking for income types of plays, that sort of stuff. And I haven't seen any for a long time, but for the first time in the 10 years that I've been writing a newsletter, I'm interested in the bank. So that's where I'm looking at the moment, and coupled that with a big area of concern about whether China has the ability to continue to grow and continue sucking in our commodities. And I know that goes against what Muzz is seeing in the charts. And I would absolutely agree with Murray. If the charts are telling you something, you have to listen, and you have to say, well, I'm wrong. And until, the charts prove me otherwise, I'll stick with the charts. But I'm talking more about iron ore. And I think where Murray's looking at is in zinc and nickel. They're a different profile to iron ore. So I think it's well worth having a crack in those areas.
Yeah, interesting. Well, it's shot by half an hour, so I don't know if you want to wrap it up there. Like, is there anything else further to say? The other thing I would say is to our readers, just write in. What do you think of this conversation, and what are the areas you want us to cover over the next few weeks and months? Anything to finish up with, guys?
Covered it off pretty much. It's a pretty crazy world we're in right now. Is the S&P about to shoot through all-time highs and go vertical? It's just an amazing world, and it's certainly fun being a part of it. But boy, it's a tricky market at the moment.
Well, maybe that's what we come back to in a couple of weeks and see if that's happened or not.
Yeah.